to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. I'm Jared Blikre, and today we have Rich Ross. He is Senior Director, Managing Director at Evercore, and we also have our all-star producer, Sydnee Freed. Thank you for joining us here today. Now, on the docket, we have our theme, Markets Are Roaring Back. Very specific terminology. We have the Dow and the S&P essentially back to highs, chip stocks jumping once again, a slew of volatility halts in the OG meme stock, GameStop itself. So, are we so back? And our word of the day is yentervention. No, we did not make that up, but we are going to tell you why a peak in the yen helps pave the way for the next China bull, potentially. And this episode is brought to you by the letter R. Why you should be tracking REITs, rates, regionals, and reggae. We're going to tell you everything that's behind that alliterative call. Now, Rich and Sydnee, we want to tackle the theme of the day. Markets roaring back. We've got the Dow, the NASDAQ, the S&P basically back at their highs. A month ago, people were a little concerned. The higher for longer thing seemed like it was going to take hold, but we're back at these highs. Where do you think we go from here?
I think we go, I just put a note out this morning, put a more specific target, 5,500 this summer. But I have quite a spicy upside target on a year-to-date basis. I think we get to 5,800 by year-end with upside to the next big round number in Q1 of next year at 6,000. So probably one of the more bullish, if not maybe most bullish strategies / upside targets out there.
Yeah, and let's talk about some of the constituents. The sector breakdown is interesting. We've seen utilities rise rather recently, but don't count out the Mag 7. And this is something you've brought a lot of charts and you're talking about today. So let's start with the OG one of the Mag 7, NVIDIA. That's been the biggest runner.
Yes, so look, semiconductors, in our estimation, are the underlying commodity of the bull market. They're the underlying commodity of technology. Technology drives the S&P by virtue of its market cap. So it's sort of, if you want to know whether you should buy or sell energy stocks, starting with crude oil is a pretty good place to begin. Mm-hmm. And again, it was a long-winded way of saying semis are probably the salient tell in the markets right now. And of course, NVIDIA, the lead dog, sort of the alpha dog of the semiconductor group, which remains in an outstanding position. And the last thing I would say about NVIDIA, for those that look at charts like myself or those that look at spreadsheets like actual investors, it's one of the rare examples where the stock's gone up 700% from the bear market lows, but yet the multiple remains the same. And that's really something for everybody, whether you invest in the momentum and the strength or the valuation, same level, 700% higher. That's quite bullish in my estimation.
Yeah, the multiple thing kind of grabbed my attention as well. Want to talk about Microsoft? You say macro hard, Microsoft. I like that. Just explain it for us a little bit here.
Yeah, so look, Microsoft, quite some time ago when we became bullish, was really the poster child, if you will, the logo for what I've deemed a Microsoft landing. And what's interesting is that software has really, as a sector, has taken a backseat to semiconductors. The economy's been more resilient, so the more cyclical semiconductors have really gotten the lion's share of the gains, up 28% year to date on the benchmark SMH ETF. But importantly, as it pertains to Microsoft, while the sector has underperformed relatively, fairly dramatically with the IGV, the benchmark software ETF, essentially flat, up just 50 basis points year to date, despite this strong global bull market. Microsoft has outperformed the group, but it's largely underperformed the other Mag, we'll call them Mag 6. Tesla belongs in its own little category. No disrespect to Tesla, just not the same chart, not the same story. But again, Microsoft is in an outstanding position. It's outperformed semiconductors as a sector. I'd like to see a little bit more over the back half from Microsoft, but I think we get it. It's a stock in an outstanding technical position with the fundamentals to boot.
Let's talk about Meta. This is a stock that just off of the lows lost 75% of its value. They went through a year of rebuilding, of turmoil, and now they're looking pretty good, back up to the highs there. What do you think of the technicals?
Yeah, look, again, Meta is in an outstanding position. Clearly, we had a hiccup. Maybe that's a polite way of saying the stock fell 10% post-earnings. Keep in mind, this was probably the most crowded, and that has sort of a pejorative connotation to it. It was the heaviest. It was the most owned of the mega cap stocks going into earnings. So the bar was uniquely high for Meta. Not to make excuses for a 10% gap down on those earnings, but importantly, the stock has stabilized. It's still in an outstanding position. And again, at almost 4 or 5% of the S&P, really has more bullish implications more broadly given its strength. But again, each of those big mega cap tech stocks, to include NVIDIA, again, in an outstanding outstanding position, and that is really one of the key pillars of this bull market.
Let me ask you about Apple. Has not done much this year. It's been in a sideways trading range since last year. Do you see it finally breaking, and to which direction?
Yeah, I do see it breaking, but higher, not lower. To your point, which was 100% accurate, the stock has lagged and continues to lag, not just the S&P, but again, that mega cap cohort, if you will, on a year-to-date basis, still down 3%. Again, in a world with an S&P up almost 10% year-to-date, global markets surging. But what's notable is the reaction post earnings. Just as we saw a gap down in Meta, again, shaken, not stirred, didn't break the chart. Apple tests and holds key support at the low end of the range, and now you're really setting the stage for a trip back up to the high end of that range at 200 and a breakout above 200. And the last point I want to make on a relative basis, when you've gone through these periods of relative underperformance in Apple, this is where you have been paid to embrace the stock after those periods of underperformance. So I think Apple is in an outstanding position. And again, from a market cap standpoint, 6% of the S&P, really important. You take Apple and Microsoft together, you're talking about almost 14% of the S&P right there.
Rich, you just sound so bullish on these mega cap stocks. Is there one that's worse off than the others? Is it all roses from here on out?
You did mention Tesla, so maybe, I don't even know if we include that, but maybe two that are worse off.
Yeah, and again, it's just a different chart. It's not a matter of liking it. And again, keep in mind, I'm the head of technical analysis. It's a department of one, so we're small but mighty in the
Same
technical
here at
department.
Yahoo Finance, I think.
Yeah, exactly. But my comments are really speak essentially just to the charts themselves, the technical. So when I talk about Tesla not being as strong as the others, again, not to knock Elon Musk, never a good idea to make enemies with the world's richest man, but only to suggest that, to your point, the big stocks, and we could bring Tesla into the equation and talk about that chart as well if we want to, but the traditional, as I call them, the original six, sort of in honor of the NHL, they're in an outstanding position, not to varying degrees, again, but the charts are quite similar. When you look at Amazon, Meta, Alphabet, you're talking about these big multi-year bases. Meta and Alphabet have broken out to new all-time highs. Amazon just on the cusp. But keep in mind, even when you talk about Amazon, as much as some people, the bears, like to point to the late 90s and say, oh, it's the tech bubble all over again, Amazon is unchanged over the last 3 years. You can draw a line that connects you to the highs that you made in 21. So I find it very hard to believe that we are in this, sort of penultimate moment of greed when you're talking about Amazon at $2 trillion in market cap, essentially unchanged over the last 3 years. And again, Meta and Alphabet not too far behind in terms of stocks that have just now reclaimed levels that we saw almost an Olympiad ago.
Yeah, I got to go.
Yeah. Well, I just want to break this one thing down for me. If you're a really beginner investor, first-time investor, you're the technicals guy, this is the time to get in on most of these big stocks. If you have nothing, you're not invested.
You make a great point. So when you look at a chart like that, and in my head, you can sort of see, it's almost like the picture of a smile, as we said, in Amazon, that's just now made it back to those old highs. So the bears come out and they say, and then that's fine, by the way. When I use that phrase, I'm not knocking. Everyone's entitled to their opinion. The point being, you've made it back to this prior reference point. So people draw the line and they say, oh, it's a double top. This is where the story goes to end. And at times it does. Not just because you've made it all the way back to a prior reference point doesn't mean you've earned the right to break out and start a new bull market. So it's my job to say which of these moves are more likely to break out and be the catalyst for a new bull phase, and which are likely to fail. So here's how I do it. I try to connect the dots from the top down and the bottom up. I think if you are a novice investor, you say, don't anchor to the lows and say, oh, how am I supposed to buy Meta or Nvidia up 700% off the lows? You say, I'm buying Amazon unchanged over the last 3 years. And I'm not saying that just because I'm bullish. I'm saying that's what we're told to, that's what sort of the good book of technical analysis teaches us, that when you have these multi-year bases of support, and now the forces that drove the bear market in terms of higher inflation, higher interest rates, tighter policy, all of those are receding on the margin. That gives you the tailwind. All of those macro forces become a headwind. Now, from a headwind to a tailwind, and I think that's how you get those multi-year base breakouts and a new bull trend in those big cap stocks.
Yeah, I love those multi-year bases. We're also seeing it in some commodities. We can touch on gold in a bit. Want to get to our word of the day, though. This is yentervention. We recently saw the Japanese yen yen weakened to levels not seen versus the US dollar since the 1990s. At the peak this month, they were 160 yen to the dollar, but the Bank of Japan is thought to have intervened recently to strengthen the yen, and we've seen some consolidation around these extremes here. So my question to you, Rich, is we've seen a lot of BOJ action before, including in 2022. Their interventions are not always believed by the market. Sometimes the market just rallies. If they want it to weaken, the market rallies. Is this time different? What does it mean for investors?
Yeah, I think the first point you make is outstanding, which is that interventions have a sort of dodgy track record of success. They sort of, provide a short-term bomb, if you will, but again, rarely is it a panacea that cures all of the ills that have weighed on dollar yen. And when I say weighed on dollar yen, of course, it's in yen terms. So higher on the charts is a weaker yen in your wallet. But again, I think you have a lot of macro cross currents coming together at the same time, which is we have the prospect for the first interest rate cut, whether it's in September, December. Again, these are up for debate. It seems like it continues to be a moving target, but these are the forces from the top down that are driving that weakness in dollar yen. Our economy has been more resilient. Our policy has been tighter. But again, we're finally starting to see that narrative ebb, as it were, as we eye that first rate cut here in the U.S. So oftentimes we see things get pushed to the brink and in terms of risk appetite, and then it comes together or it snaps. The snaps, importantly, are the exception, not the rule. And I think this is another one of those cases. The last point I'd make on dollar yen, most are overbought on the charts in 50 years. So again, just because something's overbought or oversold doesn't mean the move is over. But at extremes, we really take note of that momentum. And I would say the most overbought in 50 years, that's pretty extreme in my book. So in essence, dollar yen captured the fear that we saw that was coincident with that April drawdown in the S&P of 5 to 6%, and backing off with that intervention. Again, fundamental catalysts tend to occur at technical inflection points, and I think that's exactly what we've seen with that BOJ intervention, or so-called intervention, as it were.
All right, for our viewers on the streaming platforms, we're going to take a quick volatility pause. For everybody else, we're going to carry on with the show here. All right, we were just talking yentervention. You gave a great explanation of where we are in the business cycle with what the yen might be telling us. I want to shift to China because all of these cross currents are kind of linked here, especially in currency land. We've also seen the yuan carry heightened importance, especially as China tries to reopen. So have we seen finally the bottom in China here?
Yeah, I'm going to stop short of calling a bottom because I feel like you only get one shot at the apple in terms of calling bottoms
Twitter
and tops.
remembers.
Yeah, exactly. But I will say this. Some firms use the phrase uninvestable. Of course, we would never use that phrase for one of the world's largest economies. But the point being, you've sort of gone from uninvestable by some estimations to really unstoppable. And when you look at charts like the Hang Seng, for example, which kind of obviously gives you that Hong Kong look at China. But again, it's as good as any, sort of the venerable Hang Seng, if you will. Hard not to look at that as a double bottom, furious breakout of this multi-year downtrend. I really think it's in an outstanding position. You finally started to see some of the benchmark ETFs like the KWEB, the China Internet ETF, which is chock full of all those big mega cap stocks that they have in China, also responding in kind. So I think China's in a really strong, let's call it a tactical position, even if we'll step back from calling it a bottom in the short term. Let's call it a double bottom in the Hang Seng and a breakout from a multi-year downtrend. So you're in the best technical position you've been in years in China, and I think that's saying something.
Rich, China has really cracked down on tech in recent years. In the first year of the pandemic, Chinese authorities targeted Alibaba's Jack Ma. They threw cold water on that Didi ride-sharing IPO. So what's changed since then, if anything?
Yeah, quite frankly, I'm not sure much has changed, and I think it's one of those clouds, if you will, that uncertainty or opacity that you discussed. There's a reason why in a global bull market, China's been in a multi-year downtrend, and I think those are some of those key forces, which for some have made them uninvestable. Again, these are not my words; these are words from others. But at a minimum, even if you said it's not uninvestable per se, that was sort of a double negative, which I guess makes it investable. I think it's enough of a concern such that when you offer someone, I mean, you think about the strength in Europe, in Japan, in the U.S., in Taiwan, obviously on the back of semiconductors as well. You have a lot of options as a global investor. So to embrace China with all of these legitimate concerns out there has been a difficult bridge to cross for some. Why do you have to take those risks that are somewhat opaque, as it were, the uncertainty when you have so much goodness going on out there? But again, every market has its price, and a bottom is a function of both price and time. They've been in the penalty box now for over 3 years. Valuations getting down to that trough. Prices also at multi-year lows. So beauty is in the eye of the beholder.
Yeah, I mean, the number of times I've gotten DMs about K-Web. Oh, it's finally bouncing back. It's finally bouncing back. I have to say, to me, technically, it does look better this time. To your point, which is an excellent question, I don't think those risks have gone anywhere. So I personally wouldn't want to take them, but could be in for a monster bounce here.
Yeah, and I think markets have a great way. In trading, they say take it to a level that trades. Where the interest is. So at the right price, the story doesn't have to change. The price changes for it, and that changes the story because the risk reward to some could become more compelling. Same story, but price and valuation at a lower level could be the catalyst for some.
That sounds like it's straight out of a Wall Street movie here. All right, we got to take a quick commercial break for the letter R. This is what the episode is brought to you by. And Rich, you like the R names, and I just realized your name is an R name. But beyond that, we have REITs, rates, Russell, retail, regionals, regulated utilities, and reggae. I'm really keen to hear about this one, but what's with all the R's?
Yeah, well, first, I just like reggae. I mean, I don't know if people listen to it anymore, but, as a genre, I feel like it sort of disappeared, had its moment in the 90s when I was back in school. But all of that said, in terms of making money rather than having fun, it's interesting that all of these things that start with the letter R that you allude to, and we didn't make these up, I mean, this is how they are written, are also the most interest rate sensitive. And this is the lagging part of the market, if you will, the part of the market that's just not participating in this bullish brio that we're seeing around the world. So again, things that are interest rate sensitive, retail stocks, as illustrated by the XRT, which is an equal weight retail ETF, but we could even use the S&P consumer discretionary sector if we wanted to call that retail.
Sure.
Exactly. So it's flat year to date, and there's only one other sector of the 11 major GIC sectors in the S&P that's lower year to date, and those are your REITs. And again, what's the common theme here? Interest rates, higher interest rates weighing on your rate-sensitive REITs, obviously concerns over commercial real estate. Again, REITs sort of get painted unfairly because it's not a pure play on commercial real estate by any stretch. In fact, the exposure is lower than is traditionally believed. But all of that said, Russell 2000, another R, small cap stocks, the lower end consumer, the smaller cap company that needs more cash, has less cash on the balance sheet, there's financing needs, it's going to weigh on that small cap stock, hence your Russell underperformance. So you've got your REITs, you've got your rates. We've talked a little bit about reggae. Now, regulated utilities, an interesting story because utilities, the most interest rate sensitive traditionally, and
they're number one this year right now. And utilities are number one.
It's amazing, right? And that's why we play the games. And everything that you read about in the textbooks. I went to business school right around the corner at NYU, and again, they teach you about it in the books, and then we play the games in the real world every day from 9:30 to 4. And if you told somebody that the biggest concern on the board was higher interest rates, higher for longer, tighter policy, sticky inflation, et cetera. And yet the best performing sector is the most interest rate sensitive. So, hey, that's what makes this business fun at times. And I would buy those utilities. So maybe if I had to put a bow on that thought, I would say, wow, the interest rate sensitive side of the tape, utilities have started to respond in kind, surging up 13%, taking out that multi-year downtrend. So utilities not necessarily scared about higher interest rates. But now we need to see this summer some of the strength that we've seen in the large cap cohort start to make its way down to that smaller cap, more interest rate sensitive, more economically sensitive company.
I would like to add on reggae that
please.
I played the steel pans in elementary school.
I call you Rockstar every episode.
Exactly.
Truly Rockstar.
I don't think I could do it anymore, but it was like a requirement at my school. So,
what school? Well, we'll have to talk about this
we'll offline about that. But I was actually going to go back to REITs because we've been doing a lot of segments on REITs these days, kind of as like if you don't want to invest traditionally in real estate, should you invest in REITs? what dangers remain in kind of investing in REITs?
Yeah, look, again, I think, I don't want to compare REITs to China, but only in terms of the narrative that you outlined, in terms of some of those legitimate concerns. People talk about commercial real estate, mostly people that are bearish, but let's be fair, it hasn't been a great situation for the economy. But unfortunately, I feel like people see REITs and they just think commercial real estate, but office REITs, again, just one part of the REIT landscape. And, I don't want to do the sector a disservice because, it's really one of our best silos or verticals that we have. And we have the experts in the field that are so much better equipped to handle it. But I would say this, from the chart standpoint, whether commercial real estate is the sector or not, we know that it's not, but it gets painted with that brush. So for the purpose of investing, you kind of still in a little bit of that penalty box. And let's be fair, even if commercial real estate doesn't take up the biggest slice of the pie within the REIT landscape, there are clearly other sectors are interest rate sensitive as well. And again, as my clients, as you start out, you said, Rich, you sound really bullish. And I am really bullish. And people say, well, it's a relative world, so I have to sell something. I need to be underweight something. Mm-hmm. And quite frankly, if you had to be underweight something at this juncture, you're probably underweight something that has the most exposure to higher interest rates and commercial real estate of any of the other S&P sectors.
As we await the short squeeze, inevitably.
Yeah, and look, to be fair to your point, you're bottomed. You don't go any lower on an absolute basis in REITs, in my humble opinion. You've been doing the heavy lifting of putting this bottom in. The charts, they don't look too dissimilar from the charts of the Russell 2000, charts of the biotech, the XBI ETF. Also, the longer duration, we don't think of them as having that same sort of economic or interest rate sensitivity, but as a longer duration asset, we wait around for drugs to kind of cure all the evils out there. The higher interest rates are going away. So the charts look remarkably similar, is my point.
Very good. Something really interesting is happening today. I don't know if you've been watching the tape, the headlines. We've been dancing around the latest meme stock moves today, and it's now time for our Hollywood segment. Who wore it better? What could be better than this? We all remember the initial hype surrounding the Reddit-fueled surge in certain retail-oriented stocks like GameStop, like AMC. This was a meme stock craze. In the first 90 minutes of trading Monday this week, GameStop was halted due to volatility 9 times by 11 a.m. Eastern as it surged to as much as 120%. I went back to the GameStop peak on January 28th, 2021, found the stock had 18 halts that day, and there were 5 consecutive days where the stock traded in a range of 100% or more. So basically just crazy volatility. It's impossible to know where we are right now, what the future is going to hold if volatility is sustainable. But as of right now, who's wearing the volatility better? Is it 2021 vintage GameStop or is it today's GameStop?
I think today we're in a far superior position outside of the meme stock craze. At that time, it sort of captured the zeitgeist of coming out of the pandemic. Yes. And all of this liquidity, this pent-up savings. Keep in mind, interest rates were still low at the time. They had just begun their kind of climb. And in fact, the 500 basis point surge in interest rates in Fed funds was in part to arrest this tide of liquidity that was unleashed in that corner of the world. So I think, and I'll hold my comments to the world and rather less on the meme stock craze. Sure. I think the world is in a better position. And I like the fact that the entire market hasn't been infected, as it were, by this meme stock craze. And this time around, it's still in a couple headlines this morning. Old habits die hard. But again, I think the key focus here is interest rates and quite frankly, the bull markets that you're seeing around the world. So when you have higher interest rates, in theory, it weighs on the most speculative stock. Nothing
more speculative than these meme guys.
Exactly. And higher interest rates and tighter policy are explicitly or implicitly designed, this isn't their only purpose, clearly, to stop the meme stock craze or frenzy, but clearly that is part of what you're trying to do when you tighten policy, make it more difficult to wantonly speculate in that which is somewhat profit challenged.
Rich, we're going to have to leave it there. For the record, I believe I would agree with you. I think we're actually wearing the volatility better today, which means we're withstanding it a little bit better. We do have to go, so we thank everybody for watching us here at Stocks in Translation. Keep your dial tuned to Yahoo Finance.